Hello, income harvesters. Thanks for tuning into the channel. If you're new here, this is Harvesting Income. This is a channel where you learn how to make your income and grow your income. As you saw on the thumbnail, we are discussing about two different ETFs. On the top, you can see both of them. The first one is the IWM that you see on the top left. That is the iShares Russell 2000 ETF. This fund tracks the Russell 2000 index, which is made up of 2000 small and mid cap companies in the US. And the fund actually replicates the index performance and invests in the index stocks or constituents. Now, moving to the second one, IWMW, this is a covered call fund or a buy-write fund. The name is Russell 2000 buy-write fund, and this fund actually holds IWM. So they don't hold the Russell 2000 stocks directly. They hold the IWM ETF and write covered calls on that. So that's how the covered calls are written, and the covered calls generate income as well. So that's the basic, way the fund works. Now I'm going to compare these two funds in the video as we go further and unpack each of them and show you the comparison of the costs, the investing strategy, and so on. So let's get in. Okay, let me give you a quick background of both the funds, IWM and the IWMW. I'm going to refer to IWM as the index ETF just to make easier, and the IWMW I'll just refer to that as covered call fund or the buy-write ETF. Okay, IWM was started back in May 2000. Like it's has a long history, like 26 years, and they have assets of about 81.7 billion that you see on the left side. And this is from the iShares or BlackRock, which everybody is familiar with. And when I move on to the covered call ETF, this was started about a couple of years ago, like March 2024, and the asset size is 52 million approximately. So it's a fairly smaller fund and started recently. So the size is relatively small. Now that's the background of the funds. But now let's get into the other information like the fees. Yeah, how much you're paying in terms of the cost per year. Like for on $100, you're paying about 19 cents or 0.19 for IWM. So on a $10,000 portfolio, like it's going to work out to $19 per year. So management fee and management expense ratio are 0.19 because there's not much of management fee involved except the transaction and expenses for running the fund. Whereas if you go to the covered call side of the other fund, like the covered call fund, you have like 0.20 management fee and management expense ratio comes to 0.39, which is 0.20 plus 0.19. Since covered call funds holds the index fund, so that fee also gets added on top of the their own management fee. So that leads to total expense ratio of 0.39. Still, it is competitive and still affordable, given the fact that the fund writes covered calls and generates income every month. So that's the comparison of the fee for the two funds. Now, what is the portfolio or what are you really investing in? Like, that's the main question that you need to ask, regardless of whether you invest in a covered call fund or zero DTE fund. You need to know what type of underlying asset you're investing in. With respect to the first one, the IWM, you're investing in Russell 2000, and this fund actually takes a direct exposure to the stocks within the Russell 2000 index. So it's a direct stock ownership. And the purpose or goal of the fund is to track the performance of the Russell 2000 index. So it's a very straightforward passive index fund. Whereas if you come to the covered call side of it, IWMW, it owns the IWM, the index ETF. So this fund owns the other fund. So that's why that's why the structure is basically fund of fund, and because it owns the other fund. So indirectly it owns the stocks of the Russell 2000 because it owns the Russell Index ETF, and that ETF in turn owns the stocks. So indirectly this fund is owning the stocks, because it owns the ETF and writes the covered calls. So it is able to generate that income. So what happens in this case is, how do they write the calls? The fund manager write calls which are 2% above the market, which means 2% out of the money. So if you're familiar with options, you will know that some options are written at the money and some are written out of the money, sometimes in the money, and so on. In this case, to capture the upside, they are writing 2% above the current market price. In the previous video, you might have seen IWMW, where they write calls 1% out of the money. In this case, it's 2%, which means more room for appreciation or growth. So those are the basic features of these funds. Now let's get into the yield and returns part of it. We look at the distribution yield, price return, and the total returns to get the full picture. So IWM distributes quarterly, and the covered call funds distributes monthly because they earn premiums every month. Distribution yield is 0.9%, very small for the IWM, whereas if you look at the covered call fund, it is 21.7%. Pretty high, But this is just one side of the story. Because they write calls every month, they are able to generate higher returns. But this doesn't mean IWM is not good. Like, they are, beating the other fund in terms of price return. So that's where we are now. If you look at the price returns, the IWM index fund is giving you 40%, whereas the covered call fund is hardly giving you 0.8%, not even 1%. So that's the message. Like, you are getting higher price returns appreciation. And now, is this good? Like, I mean, is the index doing well, or is the covered call fund you doing well? Like, that's the question that we are trying to ask. Index fund versus the covered call fund. So that will be answered when we look at the total returns, putting everything into perspective. Price return wise, IWM 40%, whereas covered call fund is 0.8%. Yield wise, index fund gives you 0.9, covered call fund gives you 21.7. Now adding up the price and yield together, like, the index fund gives you 40.9%. The covered call fund gives you 22.5%, which is total of 0.8 plus 21.7. So overall, if you look at it, the index fund beats the covered call fund by almost 18%. This is all the 1 year returns. I'm looking at the 1 year performance. Of course, I will just show you the other side also, like little longer period performance or shorter period performance, to give you different scenarios. And again, this is not set in stone, not an investment recommendation. This video is purely for education purpose only. Now, what I found is IWMW, the covered call fund, is slower in capturing upside returns, and it tends to perform well in flat markets, whereas the index fund is good at capturing the upside. So I just did a quick research on the Seeking Alpha, comparing both the funds, which I can show you here. I'm just putting it on top so that you can view the graph clearly without my face hiding it. Yeah, just adjusting the dimensions to bring the numbers. Yeah, you can see here on the screen left side, on the top of the chart, top left, IWMW, which is represented in orange or amber color, is giving you 26.18, let's say 26% for 1 year. Whereas if you look at IWM, that one gives you like 42.84% per year. Like, this is the 1 year performance historical. So the index is actually pretty high, almost 43%, whereas the covered call is giving you hardly 26%. These numbers are different from my numbers because the Seeking Alpha calculation takes the dividend reinvestments also into account for the covered call fund and also for the index fund. So this is the 1 year performance. I would say it's pretty okay in looking at Seeking Alpha's numbers for the 1 year performance, because it's close to like 60% return capture. Now if I look at 6 months performance, last 6 months, yeah, you can see the covered call fund is giving 11.22, and the index fund is giving 19.45%. let me do a quick check on the math. Like this is for 6 months. Bear in mind, this is not the 1 year return. But just for the curiosity, let's look at the math and see how much return is being captured by the covered call fund. So if I look at 11.22 divided by 19.45, it's about 57%, almost 58%. It's about 57.7%. Let's take it at 58%. So close to 60, below 60, because the covered call fund is underperforming. Yes, covered call funds always underperform the index, but covered call funds should at least give you like 60% of the index returns. In my opinion, this is my own, way of measuring its performance. But if it is less than 60%, it's a point of concern. You need to keep a close watch on it. If it is more than 70%, the covered call fund is really doing well. So in 6 months, this is the story. But if I extend it to 3 years, let's see what happens. Now the index is giving you 71% and covered call fund is giving you 28%, not even half of the index. So 71, so it should be at least 35, 36 in the covered call, like 50% is 36, but 60% will be roughly around 42. That's the rough math that I'm doing on my head. But here you can see it's highly underperforming, but there is a small catch here. The covered call fund was launched in March 2024, so you don't have data for the period before March 2024. So it's not a full 3 year comparison. It's not a right apple to apple comparison. So we don't have the full 3 year data. But okay, fine. Even looking at what we have here, you can see that the performance is diverging. Like the blue line is going up pretty fast, and the orange line is trying to catch up, but it's going pretty slow, which means the gap between the index and the covered call is widening. You can see it clearly widening. Like back in April 2025, it was doing the gap was not so much, and that's everybody knows that. Like at that time, you had this tariff announcements and all that, so markets were down, and some of these ETFs were flat or probably going down. That's when the covered call ETFs were catching up and doing well. But after that period, gradually the performance diverged. But if I look at, let's say, 1 month, let me look at the 1 month performance. In terms of the 1 month performance, the covered call fund is beating the index. But usually, if you look at a longer period of time, the covered call fund will slightly underperform the index. Like, it can capture like 60-70% of the index returns roughly. So that's the rule of thumb. Like it's not a perfect ratio. Let me go back to the content like we discussed. Yeah, so if you look at the return capture ratio, it comes to 55% according to my calculation, 22.5 divided by 40.9. So, so in this case, I feel that based on this return capture, I feel covered call fund is not performing well. Like it's not meeting the expectations. So it doesn't mean it's a bad fund or you need to get concerned. But keep a close eye on this, and if you feel that it's not giving you the good returns, probably you may want to sell out and get rid of it or replace with something else. So that's the general thought that I have by looking at the capture ratio, but not a recommendation. Like you have to do your own research and come up with a plan. Now the IWMW covered call fund writes the entire portfolio, right? The covered call covers the entire portfolio, so the coverage is 100% full, so which means the portfolio cannot appreciate. The upside is capped. However, since the calls are written out of the money by 2%, 2% higher than the current market level, so even the covered portion of the portfolio, the entire portfolio, can capture that 2% appreciation. But beyond that 2%, the fund cannot appreciate because it is capped at 2%. So that is the 2% per month cap the fund has. So that's a pro in some cases, that's a con in some cases. The pro is this helps the fund to generate income. The downside is the fund is not able to appreciate fully with the market. So that's because of the covered call mechanics. Now let's look at everything put together. Like, so we have discussed all of these, earlier. So I'm going to quickly summarize this. The index ETF on the left holds the Russell 2000 stocks per the index. The covered call ETF holds the IWM. The investing strategy, index replication for the index ETF, and for the other one, it is the exposure to IWM and writing covered calls to generate income. And when you look at the return source, that's the key point that you need to look at to understand the difference. With IWM, you have index appreciation and index stocks dividends coming into the fund. So those are the two ways the fund can make money. And for this fund, covered call fund, of course, it has the IWM which can appreciate, and IWM can also distribute dividends. So those are the first two sources. The third source is premium income from writing covered calls. So that's the third way the fund generates income. I think that would be the major part. And the last part is when the fund writes covered calls out of the money, sometimes above the current market price, they purchase the ETF at a certain price. They are selling the calls at a higher price. So the difference between the buying and selling of the underlying and the call options, that would be the capital gain. So that's the fourth appreciation part when IWM is able to hit and surpass the strike prices. So four sources of income, that is pretty interesting. So that's the way the covered call fund works. Obviously, because of this, the expense ratio of index ETF is 0.19, and for covered call ETF it's 0.39. Like index ETF is about half as expensive as the covered call fund, which is understandable. Fund management, obviously, for index it's passive style, low maintenance, or something like a set it and forget it option. And for the covered call one, there is a moderate level of activity, and you also have the lower cost compared to the index replication, because the fund is holding the index ETF rather than holding all the 2000 stocks in the same ratio as the index. So that would be a very complex one. So what they have done is to simplify the operations and the costs to make it more efficient. The fund management decided that they would buy the IWM index ETF and do the call writing based on that. They would not directly invest in the stocks. So that saves a lot of time and effort, because the heavy lifting is already being done by IWM, which is the index ETF. Now, the drawbacks. No fund is perfect. Like every fund has its own pros and cons. I don't see much of drawbacks with index ETF, except that it may be boring, it may be low income or lower amount of activity. But that's a great option for passive investors or someone who wants to have a long-term set it and forget it kind of portfolio. However, when you look at the covered call side, the upside is capped. Like when the market rallies by 5% or 10%, the upside is capped at 2% level. And when there's a decline, the fund covered call fund is going to capture all the downside. So that's on the downside, it's capturing the entire thing, but there is some premium which is compensating the downside, and premium also on the upside it's actually putting a cap because of the strike price. So that's a kind of design or feature of the fund, and it has its own pros and cons. So when the index is declining, it can drag the fund's net asset value. So that's a concern that you need to look at. But if the index recovers, it is gradually going to recover. Okay, what kind of investor would like to have the covered call ETF? What kind of investor would like to have the index ETF? To put it simply, someone who wants to hold the index and just set it and forget it for the long-term investment. A passive investor or moderately active investor would prefer the index ETF. However, one caveat here is this is suitable only for investors who can stomach the small cap stocks volatility and the uncertainty with small and mid cap companies. And this is not recommended as a core investment. So that's the quick summary of the index ETF. Now moving on to the covered call side, a passive or a moderate investor would like to have this fund. However, uh, they are able to generate income. The only downside is they are getting that upside cap, which puts a cap or a limit on the appreciation when the market is rallying. Similarly, when there's a market downturn, they are capturing all the downturn and decline in the prices. So that's the drawback of the covered call fund. And in this case as well, even for the covered call investors, this cannot be a core part of the portfolio. It could be an add-on, or it could be a smaller part of the portfolio because of the risk related to all these small cap companies. So there we have it. There we have the comparison of these two funds. Let me know which fund you like or which fund you want to go ahead with in case you want to look at these two funds. Drop in your comments or thoughts below. I hope you liked this video. If you liked what you're watching, please share it with your close friends or family. And if you want to support the channel, please give a like or subscribe to the channel. Thanks a lot for watching. Have a great day. Happy investing.